Good morning, everybody. It's nice to be here in Adelaide. It's actually my first time here in Adelaide, so yeah, it was really impressive to see your sort of really nice, neat and tidy city with, you know, lots of great, interesting buildings, but without all the congestion and clutter that we see in Sydney. So I'm going to give you a bit of an economic spin today. So over the past several months now, we've increasingly been hearing concerns and feeling concerns about the health of the economy and what lies ahead. So today I'm going to run through how we see the economy tracking and how we see growth unfolding over the next couple of years. And hopefully I'll answer the question, is the gloom that we're hearing and feeling at the moment, is that justified? So I'll just start with where we're actually sitting at the moment. So Australia is in its 28th year of economic expansion. We haven't had a recession now since the early 1990s. We've got growth running around its long-run trend pace, so around 2 3/4, although there has been quite a marked slowdown in growth over the second half of 2018. The growth that we have had has been sufficient to push down the unemployment rate. The unemployment rate's now sitting around 5%. That's the level that we would typically consider to be full employment in the economy. We're starting to see wages growth respond to that stronger jobs market. We're seeing wages growth now trending up again, although not perhaps fast enough to really shift the dial on inflation. Inflation is still very low. Commodity prices are holding up at really quite robust levels. That's generating a lot of income in the economy. We've also got the budget deficit shrinking at a really fast pace, and it's likely we'll see a budget surplus very soon. The rating agencies have reaffirmed Australia's AAA credit rating, and we have a lot of spare policy capacity. So the RBA cash rate's sitting at 1.5%, so there's still, you know, quite a bit of room for further cash rate cuts if there was a slowdown in the economy. We've also got a lot of fiscal room as well. The government budget is in good shape. There's a lot of fiscal room as well for extra government spending if the economy was to turn down. So all these can be seen as really good results. It's a really good starting point, a good place to be. Despite that really reasonable backdrop, we've seen a lot of increased pessimism over the last 6 months or so around the outlook and where we're headed. So that pessimism can be sort of broadly sourced back to two main themes. First of all, downside risk to the global economic story. So there's a whole range of factors that you can choose from there to be concerned about. There's the US-China trade issues, there's developments with Brexit, and we've heard a lot about Brexit this week. A weak Chinese economy, there's lots of stories on that front. There's been financial market volatility, geopolitical issues, and the list goes on. In terms of the risk to the domestic story, they mainly centre around the household sector and how household spending is going to evolve in an environment where we've got very high debt levels and wages growth still quite low. And now added to that mix, we've got falling house prices in some of the capital cities. So these risks are real. I'm going to talk about them in the presentation, but I also want to just make you aware that probably some of these concerns have been a little bit overdone, and we think the economy can still turn out some decent outcomes this year. So I'm just going to talk a little bit about the fourth quarter 2018 GDP numbers that were released last week. So those numbers have received a lot of attention. So we got quite a weak outcome for Q4 GDP with growth of just 0.2% in the quarter, and that was disappointing because it followed on from a weak Q3 where we got growth of only 0.3%. So we've now had 2 weak quarters in a row. And there's been a lot of headlines in the press about the fact that we're now in a per capita GDP recession. So in per capita terms, GDP's actually declined for the past 2 quarters. So I just want to make a few points there. There's another measure in the national accounts called real net national disposable income. And that's a better measure of living standards compared to GDP per capita. So real net national disposable income, that includes growth in the economy, but it also measures some of the income effects as well. So it's a closer measure of how our living standards are tracking. And if we look at that on a per capita basis, we've actually continuing to see real net national disposable income increase, not decrease. So if you're looking at that metric, we're certainly not in what you'd call a per capita recession. Another point to make is that slowdown in the economy over the second half of last year. It really sits at odds with a range of other economic indicators, particularly the labour market. So I've got a table on the slides up there, and you can just see, while real GDP, that the first number in that table, while that's really slowed over the second half of last year, a number of other measures have actually grown at a stronger pace and are looking really good. So employment growth, for example, sitting at 2.5% over the second half of last year. That's a really good pace of employment growth. So the RBA have noted these disparities in the data. They've talked about that in some of their speeches. They've talked about that that they're devoting a lot of their resources to understanding why these GDP numbers are quite weak, but the labour market's still strong. We think the labour market's probably a better indicator of what's actually going on in the economy. The GDP data is often revised, and those revisions can be really quite substantial, and you can get down the track, those numbers can change, and you can see quite a different story than what you were being told at the time. Also, other data such as personal tax receipts that the government's collecting, they're very strong as well, and so they line up with that stronger labour market data. So we are putting a little bit more weight on those labour market outcomes as opposed to the weaker GDP outcomes. So I talked about some of the increased risks in the economy at the moment. So policymakers have acknowledged those risks, and the guidance on interest rates has changed. So throughout the whole of last year, we had the RBA Governor, Phil Lowe, in all his speeches and in many of the RBA's communications, they included the line that they saw that the chances of the next move in interest rates more likely being up rather than down. Although early this year the RBA changed that guidance, they're now saying that the risks are more evenly balanced. So if we see the unemployment rate fall further, wages growth pick up further, and inflation starting to gain momentum, we could expect to see interest rates go up. But on the other hand, if the unemployment rate starts to go up, we could perhaps see an interest rate cut. So the Governor's made it pretty clear that it's the labour market that we're to watch at the moment when they're thinking about deciding on interest rates. They're really looking at the labour market outcomes and particularly how the unemployment rate unfolds. And more recently, he's given us some more information on that front, and he said that they would want to see a sustained rise in the unemployment rate before they would be thinking about cutting the cash rate. So not just 1 or 2 week labour market outcomes, but really seeing that unemployment rate tracking higher before they would cut the cash rate. So our view on the cash rate is we'll probably just see the RBA stay on hold for several more years to come. So, sorry, just on the global backdrop, so we are hearing a lot of negative headlines on that front, and it is fair to say that the global backdrop is less supportive than it was in, say, 2017 and the first half of 2018. And we've seen growth slow in many of the major economies. One point worth noting, though, is that the major forecasting bodies like the IMF and the OECD, they are still expecting the global economy to run around its trend pace over the next couple of years, although they have acknowledged there are some downside risks, but their central forecast is for trend growth. And trend growth, you have to consider that to be a good outcome. Turning to the domestic side of the growth equation, just in terms of the growth drivers in the Australian economy, we know several of those growth drivers are what we essentially would call locked in. So our commodity exports, particularly LNG, the LNG is going to be a major driver of our commodity export volumes over the next couple of years. And those LNG volumes are essentially locked in because that LNG is sold under long-term contracts. So we consider that part of the growth story to be locked in. Also, infrastructure spending, that's another big part of the growth story at the moment. And a lot of those projects tend to be run over many, many years. And so we consider those essentially locked in as well. Those projects are already underway and they will be carried out to completion. Another growth driver for Australia stems from the Asian income expansion. So as more and more of the Asian countries and people in those countries move into those middle income brackets, they tend to demand more services, so things like tourism and education. So Australia is really benefiting from that. Again, that's probably less locked in than some of those other drivers, but we've seen how committed the Chinese government is to maintaining steady growth in their economy while they're addressing some of the vulnerabilities. So we think that given their commitment to maintaining that steady growth around the 6 to 6.5% in China, we think it's fairly safe to say that Australia is going to continue benefiting from that tourism and education boom that we're seeing for quite some time to come. I'll just note some other positives in the economy that had been seen as risks a few years ago. So first of all, we're seeing wages growth now lifting. For a long time, wages growth was falling. People were worried that that was going to go on even further. It's clearly turned around now with wages pressures starting to emerge. Also, non-mining companies are really investing quite strongly now as well. Again, after a fairly long period of pretty lacklustre investment, we've seen a really sharp pickup in non-mining capex. And the ABS surveys these companies on spending plans going forward, and the spending plans are showing that these non-mining companies continue to see their capex spending rise over the next couple of years. I'll take a quick look at the labour market. The jobs market's in good shape. Employment growth has been very strong. The unemployment rate's coming down, and the underemployment rate is moving lower as well. In terms of where the jobs market's headed, we've got a few different series that are good leading indicators of jobs growth, various different business surveys, and also the ABS job vacancy series. They're still holding up at quite strong levels, suggesting that the jobs market will stay in good shape for at least the next 6 months or so. So I guess the real areas of concern in the economy at the moment centre on the housing market and the consumer. So we saw lots of steps taken by the different regulators to address financial stability risks that were emerging from the housing market. And one of the major changes was APRA's decision to limit interest-only lending. So that change reduced financial stability risks, but as a result, it introduced a macroeconomic risk. And by that I mean we saw a lot of investors switch from interest-only loans to principal and interest loans. And as you switch from interest-only to principal and interest, the repayments tend to rise by 30 to 40%. So that's been a big hit to household budgets for people that had an interest-only investment loan. And that change by APRA was what kicked off the latest downturn in dwelling prices, which has been focused in Sydney and Melbourne. It's also now producing what economists call some negative wealth effects, where consumer spending slows down in a response to seeing the value of often your greatest asset declining. So we think prices will fall further in 2019. We probably see price falls continuing until about the mid-year. So the table up there shows you the details. It's very much a Sydney and Melbourne story. Prices are falling in Perth as well, but that's been in response to the downturn in the mining sector there. If we look here in Adelaide, we see house prices still posting small monthly gains. So there are a lot of differences around the country. And in our forecast, we have the falls continuing to be concentrated in Sydney and Melbourne. There are some offsetting forces coming into play though. First home buyers are starting to come back into the market. Now housing is more affordable. We've still got population growth running at very strong levels. That underpins demand for housing. And we also have residential construction now starting to fall. And again, that's another factor that will reduce supply and again just underpin the housing market. So we don't see the housing market falling too much further, especially in this environment where we have a strong jobs market. Just a little bit more on those negative wealth effects. That is something that the RBA are a little bit concerned about and have been doing a lot of research into that. So we have seen consumer spending slow. It's slowed though in all states, so it's slowed down even in the states that aren't seeing house prices fall. So it's not entirely being driven by that downturn in the housing market. There are other factors at play, and it might be just the negative headlines that we're hearing about the economy following the weak Q3 GDP data that we had and then the weak Q4 outcome as well. That's probably weighing on consumer sentiment. So the RBA research does show that these wealth effects do tend to be quite small, and what is the most important factor for consumer spending is income growth. And on that front, there's some good news. We do have wages growth lifting, although it is still low. We've got strong jobs growth. So the combination of good jobs growth and a lift in wages growth is really good for household incomes. It's also looking likely that we could see some further personal income tax cuts in the budget in April, and again that would be a really good positive for household balance sheets as well, household income growth. So just to sum up what our view is, we think we'll see trend-like growth in the global economy over the next year or so. We think the Australian economy will probably grow just a little bit below its trend pace, with the main risk there coming from the consumer side of the economy. We've got the unemployment rate tracking broadly sideways. We think the RBA will keep interest rates on hold for the next couple of years. And we think the Australian dollar will probably stay in the low 70s throughout this year. So I focused today a lot on the risks, but hopefully I've been able to give you a taste of the positives and give you some perspective to show you that we can still expect reasonable growth outcomes over the next couple of years. That's all. Thank you.